Have you noticed international oil prices dropped 20%, but gas station prices barely changed? That's the secret of commodities. The price you see and the price that actually affects you are separated by an entire supply chain. Many people rush to buy energy stocks when oil prices rise, then get stuck when oil drops. Why? Because you only saw the price, not the cycle behind it. Before we start, subscribe and hit the bell. Today I'm teaching you commodity investing basics. Commodities have 3 cycles. First, demand cycle. Economy good gives factories running, gives need copper, need oil, gives prices rise. Economy bad gives factories idle, gives demand shrinks, gives prices fall. This is the most intuitive. In 2021 post-pandemic recovery, global factories ran full capacity. Copper prices rose from $2 to $5, a classic demand cycle example. Second, supply cycle. OPEC cuts gives oil prices rise. Mine strikes gives copper prices rise. But building a mine takes 10 years, closing one takes a month. Supply cycles are often more violent than demand. Why? Because resource extraction is capital intensive and long cycle. Discovering a new copper mine, exploring, building, and bringing to production takes 8 to 10 years. But once demand shrinks, mines can immediately reduce output or close. This asymmetry causes supply to always lag demand or overreact. After the 2022 conflict, European energy supply tightened and natural gas prices skyrocketed, an extreme supply cycle case. Third, inventory cycle. Low inventory gives price support. High inventory gives price pressure. This is the indicator short-term traders should watch most. The U.S. Energy Department publishes weekly crude oil inventory data, and the market watches this number closely. If inventory is lower than expected, oil prices often bounce immediately. If higher, prices face pressure. Inventory is like a cushion. Thick cushion, prices fall slowly. Thin cushion, prices fall fast. Why did gas prices stay high when oil crashed? Because the gas you pump is a downstream product. Between crude oil and your gas tank, there's refining, transportation, and retail. Crude is extracted from underground, sent to refineries to process into gasoline, then transported via pipeline or tanker to gas stations, and finally pumped into your car. Every step has costs: refinery equipment, depreciation, worker wages, transportation fuel, gas station rent, and labor. These costs are fixed and don't immediately drop when crude prices fall. So even if crude drops 20%, finished product prices might only drop 5% or not at all. This is the supply chain buffer effect. So how to pick commodity stocks? 3 dimensions. First, supply chain position. Upstream, mining, drilling is most price sensitive. Highest volatility like a roller coaster. Oil up 20%, upstream profits might rise 50%. Oil down 20%, profits might go to 0. Midstream, refining, processing, has cost plus margins, moderate volatility. Downstream, retail, consumers, has pricing power, lowest volatility, like a stable train. Even if oil prices drop, gas stations maintain relatively stable profit margins because they mark up at a fixed percentage. Beginners should start downstream or midstream. Don't jump straight into upstream. Second, cost curve. Whoever has the lowest cost survives longest when prices fall. This is the core logic of commodity stock picking. If oil drops to $60, miners with $40 costs still make money. Those with $80 cost are already losing. This is cost mode. At cycle bottoms, low-cost producers not only survive but can acquire high-cost competitors. When the cycle reverses, they have larger market share and higher profits. So when picking commodity stocks, first look at whose costs are in the industry's lowest quartile. Third, inventory cycle. When inventory is low, even without demand surge, prices tend to rise because supply has a floor. Entering at this point has higher win rate. Conversely, when inventory is high, even with good news, prices might not rise because of oversupply. Inventory data updates weekly or monthly and is the indicator short-term traders should watch most. Specifically for 3 commodities. Oil, watch OPEC production, U.S. shale output, global inventories, mapped stocks, upstream, XOM, and COP. These are the lowest cost giants. Downstream refiners with relatively lower volatility. Copper. Watch global mine output, EV penetration, China infrastructure demand. EVs use 3 to 4 times more copper than gas cars. This is long-term demand support. Map stock, FCX, is copper leader. Gold. Watch real rates, geopolitical risk, central bank buy. Real rate equals nominal rate minus inflation. The lower the real rate, the more valuable gold becomes. Mapped stock. NEM is gold leader. Remember, gold stocks aren't gold. They have leverage. Volatility is 1.5x to 2x gold itself. Gold up 10%. Mining stocks might rise 20%. Gold down 10%. Mining stocks might drop 25%. Avoid. Don't buy at cycle tops. Those who rush to buy energy stocks when oil hit $130 in 2022 are still trying to break even. Commodities are cyclical assets. Buying at highs and selling at lows is the standard retail mistake. The right approach: enter when inventory is low and prices are bouncing from the bottom. Exit when inventory is high and prices are euphoric. Final word. Commodity investing isn't guessing prices, it's reading cycles. Hit subscribe. I'll warn you before the next cycle turn.